The interesting part about trading the different sectors, as much as the fact that the UK 100 is supposed to represent the underlying UK economy, interestingly, same with the US 30 representing the US economy. Companies nowadays are so internationally based that it's quite hard to really focus just because the FTSE 100, just because the UK economy is booming or is flagging, the FTSE will necessarily do the same, because the companies that go to make up that composure, the composition of the index are quite international companies nowadays. One of the things I think, so you look at the UK index, it's quite commodities based, it's quite oil companies we talked about earlier, gold, and banking is quite strong. The Nasdaq, for example, is obviously much more of a technological market. The DAX always used to be viewed as a tech market. The Wall Street is obviously much more traditional blue chip stocks. I think it's worth having a bit of an understanding of what will drive it. The Australian index is obviously very much driven towards the price of gold, or the price of oil, or the more exotic precious metals, because that's what their economy is based on, and that's what the stocks that are quoting down on the Australian index will be representing. I think again you need to look for what the pace of the movement of it. Maybe the best example would be that something like the Dow Jones, purely because it's trading up at 15,000, will trade. If a 1% move in the Dow Jones represents many more ticks than 1% move in the French CAC market, because that's trading down at 5,000. So I think it comes down to horses for courses. Pick a market, pick a pace of market that you feel comfortable in. We quote 1 point spread across all those markets. The opportunities are there in them. Similarly, the pitfalls are there in all of them, and it's just the pace at which you're comfortable with that market moving, and maybe also the size that you're going to trade in that market because of the aforementioned pace.